If you and a friend, family member, or business partner want to buy property together, but you don't want to be legally responsible for their mortgage if something goes wrong, this video is for you. Because there is a way to co-own real estate where you have your own mortgage, you have your own percentage of ownership, your credit is separate, your loan is separate, and your financial future is protected. It's called a tenancy in common loan, also known as a TIC loan. And it's one of the most misunderstood financing structures in real estate today. In this video, I'm going to walk you through what tenancy in common ownership actually means, how TIC financing works, the difference between group loans and individual fractional loans, who this is designed for, the risks you need to understand, program guidelines, and how to structure it correctly. By the end, you'll know whether a TIC loan makes sense for your situation. Hi, I'm John Thomas, loan officer with the John Thomas team at Primary Residential Mortgage, and I'm going to explain all this for you. I've structured non-QM and specialty financing nationwide, and tenancy and common loans are one of the most strategic tools available when co-buyers want protection and flexibility. Let's break this down clearly. Let's start with what is tenancy in common. Tenancy in common, or TIC, is a legal form of co-ownership. Two or more people own a property together, but here's the key. You do not own a specific unit. You own a percentage of the entire property. If three people buy into a 4-unit building, you might own 33%. Your partner owns 33%. The third owner owns 33%. You don't own unit B. You own a percentage of the whole property. Your TIC agreement then gives you exclusive occupancy rights to a specific unit. That distinction matters for financing, taxes, estate planning, exit strategy. One of the biggest advantages of tenancy in common is flexibility. Ownership percentages do not have to be equal. You can structure 50-50, 70-30, 60-25-15, any split that reflects actual investment. If one buyer brings more down payment, they can own a larger percentage. Equity distribution follows ownership percentage, but access rights are governed by the TIC agreement. That flexibility is why TIC is often superior to joint tenancy for non-married co-borrowers. TIC versus joint tenancy. Tenancy by entirety. Most buyers don't even realize that the multiple co-ownership structures. Let's simplify it. Joint tenancy, equal ownership only, automatic right of survivorship. Your share goes to your co-owner if you die. Tenancy by entirety, married couples only, automatic survivorship. Tenancy in common, unequal ownership allowed, no automatic survivorship. You can leave your shares to your heirs. For most friends, siblings, investors, or business partner, TIC is the most flexible and protective structure. How does TIC financing actually work? This is the most important part. There are two ways to finance a tenancy in common property. Option one, group financing or a blanket loan. All co-owners sign on to one mortgage, one loan. All borrowers, one person stops paying. Everyone is responsible. If one person defaults, the entire property is at risk. That's how TIC used to be financed, and it creates a serious exposure issue for all individuals. Option two, individual fractional financing. This is the game changer. Each co-owner gets their own mortgage, their own underwriting, their own note, their own payment, secured by their fractional ownership interest in the property. If one co-owner defaults, only their share is affected. Your mortgage is untouched. Your credit is untouched. Your payment is untouched because that's not your fractional ownership that got defaulted. This is why modern TIC financing has expanded dramatically. It allows shared ownership without shared financial liability. The programs I offer use this individual fractional model. Who is a TIC loan built for? This is not for everyone, but it's for the right borrower. It solves major problems. Friends or families buying together, two siblings buying a duplex, three friends investing in a 4-unit, parent co-buying with an adult child. And some properties are set up with fractional ownership, so you have to get a TIC loan. Each person gets their own loan. Each owns their own percentage. Each is protected individually. Buyers who can't qualify a loan, maybe your income alone doesn't support the target price. Pooling resources can open doors while keeping loans separate with TIC. Investors, TIC works well for multi-unit rental properties, DSCR income qualification, portfolio building. Each investor controls their leverage independently. High-cost market buyers. In markets where entry-level properties start at $700,000 or more, TIC co-purchasing can mean owning instead of renting indefinitely. Who is TIC not for? If you and your co-buyers have major communication issues, have totally different long-term goals, refuse to draft a proper legal agreement, TIC will not fix that. Structure protects you, but it cannot fix poor planning. Tenancy and Common Loan Program Guidelines, or TIC loans. Here's what typical TIC programs look like. Loan amounts starting at $250 at a minimum, up to typically 2.5 million. Max loan to value 85%. Minimum FICO score 660. Occupancy can be primary residence, second home, and investment property. 2 to 4 unit residential with separate occupancy rights. Down payment, typically 15 to 30% rates, usually 0.5 to 1% above comparable conventional. All non-QM documentation types are accepted. That means W-2 income, bank statements, 1099 income, P&L, DSCR, asset qualifier. And here's what's powerful. Each co-buyer can use a different documentation type. One can use W-2, the other can use bank statements because they have separate loans. All right, the TIC agreement. The TIC agreement is the most important document in the entire transaction. It must address ownership, percentages, occupancy rights, expense allocation, exit procedures, default provisions, right of first refusal, death and inheritance, dispute resolution. The lender reviews this agreement before approval of a TIC loan. Do not use a template. Hire a real estate attorney in your state. This document governs your relationship for as long as you own the property or own your fractional share. Pros and cons. Advantages: increased buying power, individual financial protection, flexible ownership splits, estate planning control, works for primary and investment. All non-QM doc types are allowed. Risks: slightly higher interest rates, not offered by most banks. Exit can be complex. Any owner can sell their share. Partition actions possible if disputes arise. This is why structure matters. What happens if someone wants out of the TIC agreement or sell their fractional ownership? There are 4 common exit scenarios. Sell your shares to existing co-owners, sell your share to an outside buyer, sell entire property, partition auction, court-ordered sale. A strong TIC agreement makes exit predictable and controlled. A weak agreement creates chaos. How TIC compares to other non-QM options. If you're buying a loan, DSCR is great, bank statement, asset qualifier. They're all simple ways to purchase without a lot of income documentation. If you're co-purchasing and both need individual loans, TIC is the product built for that scenario. When TIC is likely right for you, you want to co-purchase, you need individual financing, you want financial separation, you want estate planning control, you're buying 2 to 4 units with separate occupancy. If that sounds like you, this deserves a real strategy conversation. Tenancy and common financing is not something you figure out after you're under contract. The structure matters before you make an offer on a property. If you're considering co-purchasing or you're interested in a property that is already a tenancy and common, call me directly, 302-703-0727. We'll review your income documentation options, your co-buyer's profile, your property eligibility, the TIC agreement requirements, and whether this is the right structure for you. If you're going to co-own property, do it the right way. I'll see you in the next video.